Hello, welcome to Market Call. I'm Michael Hainsworth. For the next half hour, David Burrows is here. He is the president of Barometer Capital Management. He's here to take your calls, your email messages, and tweets on North American large caps. There he is. Call him toll free, 1-855-326-6266. You can email marketcall@bnn.ca if you prefer, or follow me on Twitter and send off a tweet. David, hello again.
Great to be here.
Keeping a close eye on the goings on in Japan these days?
We are, because we've been in an equity market. If you look at what drives equity markets, you get earnings on one side and you get monetary policy that has an impact as well. And clearly we've been in a market where it's been driven by monetary policy because the most economically sensitive group is just really not participating in this market. We got another big boost as yield investors when the Bank of Japan publicly came out to say that they were going to basically double money supply over the course of the next year.
And how does that translate into North American equities?
Well, it's very interesting. If you poured water on a table that has a hard surface and doesn't soak in, it bounces around everywhere. And in effect, what they've said is they're going to make bond purchases in excess of twice what the US Fed is doing, which basically means you're buying in bonds and creating liquidity in the system. 97% of bonds are owned by Japanese insurance companies. They've historically scoured the earth for yield. So they're readily selling those bonds at 0.4% returns and turning around and looking around the globe at REITs, at midstream energy assets, at things that generate cash flow as a proxy on bonds. And I think that we're a big beneficiary in North America.
There's an argument to be made, though, that the stimulus cash they're shoveling into the U.S. economic engine is having a less and less of a return on investment.
I think there's no question it's having a very moderate, if not unsuccessful, impact on growing the economy. But it is finding its way into financial assets. And people are taking cash and moving it slightly out the risk curve to things that give them a better cash flow or return with risks that aren't really much in excess of a treasury bond.
Well, we are talking North American stocks today. You more pro-U.S. equities than Canadian ones at this juncture?
We are. We have more U.S. exposure today than we've had in a long time, specifically because certain sectors are performing really well that we don't have depth in the Canadian markets, and a lot of the Canadian sectors really have been out of favor.
What sectors do you like stateside?
So, we continue to like anything with real predictability in the cash flow and strong, well-defined dividend policies. If you look at what worked in the first quarter, and you got to focus on what works in a bull market, it was staples, pharmaceuticals, things that are very predictable. They were both up 10, 12%. Both of them are sectors where dividend policies are very clear. And it's interesting, there's all kinds of companies in those groups that pay yields well in excess of treasury bonds with dividend growth, and where the market has assessed that the risk of default is less than a U.S. treasury bond. In other words, their credit default swaps are cheaper than a U.S. treasury bond.
Let's take a break, come back, find out who qualifies for that then.
Great.
David Burrows is here. He is the president of Barometer Capital Management. We're talking about North American large caps. If you've got a question, call us toll free, 1-855-326-6266. When we return, we'll talk about one of Canada's big gold diggers.